I'm sorry I've been gone for a couple of weeks. I bought a trophy property in Payson, Arizona, which is about an hour and 15 minutes north of Scottsdale, and it needed a lot of work. So that's what I've been doing. So I apologize for being gone for a while. I do want to continue the story. I think that I am wildly bullish a few years out. We are going to make an absolute fortune. We're going to make some stunning buys in much sooner time. I can see it on our charts. And we're going to talk about that. So only 3 times in your life are you going to have an opportunity what's coming now. It's just truly amazing what's going on. And I think that you are going to be very pleased with what's going on. Unless, of course, you're not prepared. If you're not prepared, you're going to get steamrolled. This is going to be awful. Now, I have lots of questions. So, people ask me, I can see it on the charts. So I've been talking about this for a long time. And if you don't believe in charts or timing models or cycles, I'm going to add some other things so that you can just see the why of this. But we can see it on charts. And I'm going to make some simple observations because it has astounded me. I've been skeptical in my life as well. But we're humans. We have frailties. We seem to continue to do this over and over again. And these cycles are very real. Virtually everything is cycles. And once you start seeing the cycles, you can start making some predictions. I am still an amateur at it, and I'm learning every single day. But my models are good enough to tell me that things are what are happening and what to expect. And there are signposts as we go along, and the signposts have absolutely positively been coming right along. And so the next signpost I am looking for would be a waterfall event, pretty much a down. And there are trigger events. And one of the trigger events, if you follow my videos, maybe it's been a couple, 2-3 weeks. I saw that. I thought we had a monetary credit event. It still looks that way to me, and I think that's one of the things that are going to trigger this event. I'm going to tell you that the moment that the Federal Reserve starts to reduce interest rates, that is another trigger. I think all hell will break out at that point. So that's kind of like a realization. They're last to go. All the central banks around the world have been reducing rates. I mean, the Swiss National Bank is down to almost zero. And they say they'll go below zero because they are scared to death. The Eurozone, Canada, Australia, but the Federal Reserve is hanging in tight. They will eventually capitulate because the economy is deteriorating. Let me go to my next slide here so we can just discuss this. I don't want to make this a terribly long slide. So only 3 times in your life are you going to get this opportunity, and it's very simple. So this is the timing model. As you know, I talked to Charles Nenner. He's done this. He's way better than I am. But this is just as simple. In my asset class, in the real estate asset class, let me see if I can open this up just a tad bigger so everyone can see this a little better, and we can talk about that. There are just some things that just happen. So this is 14 years up. In the way up, we're going to have typically one mid-cycle correction. This cycle had 2. Not unusual to have 2. I mean, it's not impossible. It did have 2. It happened before. And they came in right on time. This is the accumulation phase. This is the explosive phase. And all this fun that we had going up on this side is mimicked on this side. And just last week, when I did a seminar in Scottsdale, Arizona, one of the people got up and said they just got statistics in. And Scottsdale, Arizona, the prices in Scottsdale, Arizona went down 3% in April. So if they continue to go down, which I expect them to do, you could easily get 10 months of 3%, and you're down a lot. These are a couple things. Now, if you're following John Hussman, he is a brilliant mathematician, brilliant hedge fund manager. And I follow him. He sends out his newsletter. And John Hussman on it said, "We are presently on high alert for a possibly abrupt and cascading market and economic dislocation in the weeks ahead." And I think that we are going to have that. We just need to be very, very careful with it. Nothing you can do about it. You can prepare for it, but you can't stop it. And this is what I saw. And I think, a lot of people didn't really look at it. We'll talk about this in a little bit, but we saw a very interesting thing is the stocks went down and the bonds went down as well. Typically, when the stocks go down, people go from stocks into bonds, and that's the safety of the bonds. Bonds went down and interest rates went up. And that, to me, is a credit event, which is telling me that people are in trouble and they're selling their reserves. Banks are, banks in Europe are just in just terrible, terrible shape. And of course, I think we have, a lot of these commercial properties, which is leading the cycle. When you lose $300 or $400 million on a tower, that's a significant loss, and they have to sell the reserves. And when you sell the bonds, which typically are your reserves, what happens? Interest rates go up. Now, if you're a foreigner and you're selling your reserves, and which happen to be there, as a reserve currency, a lot of the banks around the world will maintain their reserves in U.S. Treasury bonds and bills and notes. And when you get them and you need to sell your reserves, you sell them. Puts pressure on the bond market, interest rates go up, but now you have to convert them into dollars because, quite honestly, you can't use into local currency, so you get dollars, and now you have to sell the dollar and buy yuan or pesos or euros or marks in order to pay your bills. And what does that do? That puts pressure on the U.S. dollar as well. This is exactly what happened in 2008. You can look at the charts and see that. And then the U.S. dollar bounces back because it's no longer people selling them or trying to buy them as a safe haven. So it's a really interesting thing. It doesn't happen very often, but it did happen last week. And I saw that. I should have probably have done a video on it, but I'm sorry, I'm involved in this project. Oh, I'm finishing up, so let me go to my next slide. So let's just, let's see if we can get this. Oh, I have to go over here. Sorry about that. There it is. Now, when you look at this, and I know everyone is using the Case-Shiller averages. Case-Shiller is a very good index. I'm sorry, I would never, ever say anything about Dr. Shiller. These guys were brilliant, but it's different. So I track the U.S. median home sales price because averages, you get a lot of sales at the high end and it drags the averages up, and it's really not as indicative of what the market is doing. So we use the median, and it's not used everywhere, but we get this from Federal Reserve electronic data, and you can see that Q4 2022, the U.S. median home sales price peaked. It peaked, as in it's not going any higher, and it's 2 years in arrears for us, and it has been holding up. So we're going to call that as the peak Q4 of 2022. It's a pretty official. Here in Phoenix, Arizona, we all peaked right in that June, July of 2022. We were leading the market just a little bit, and you can see that throughout our indices. Now, I will tell you that there is a real bifurcation of this in that the expensive homes, we start going into luxury, $2.5 million, $3 million in Scottsdale, Arizona. They are selling basically for cash, and they are really unaffected by affordability. People who can afford a $3 million property typically don't finance. I mean, if they do finance, it's just not a problem. They're financing for convenience, and they're really unaffected by this. But now you get down into affordable homes where people are limited with their capital. Yet, we have a disintegration of demand, and they just cannot afford it. So that's an affordability problem. That's my marketplace. That's what we're talking about, basically, is the affordable home space. Let me go to my next slide here. Now, this is really, really easy. This is just really, really easy. It's typical. When you have a real estate cycle, it is 14 years up and 4 years down. Now, can it be 15 years? Yes, it can. It can go more to 16. It can. Nothing says it has to be exactly 14 years up, but it's typically around that. So around 13 and a half to 15 and a half years could easily be, but it goes to a peak. Once the peak is in, we're no longer worried about going up. Now we're worried about talking down, and that is like 4 to 4.5 years. Now, could it be 5? Yes. Could it be 3.5? Yes. But it's not going to be 10. So we've got the peak, and for me, the peak is absolutely positively in, which then says, when does it end? Well, that means it should end Q4 of 2026 or Q1 of 2027. That's pretty close. So what happens in the meantime? Because this is typically, you can see this red line, I put that in. And that's typically what happens. But you can see this is coming out of Federal Reserve electronic data. It's really good data. And we peaked, and I think it'll squiggle a little bit like this, and then it comes down, and that's a waterfall event. Now, we've talked about this before too. So let me just open this up a little bit. Now, there's 12.2 million FHA loans that are delinquent. The Biden administration hid all this to make Biden economics a reality. Of course, it wasn't reality. It was just they were gaslighting us. So in 2004, so Biden is still in power, they had 9 foreclosures in FHA. 2005, Trump comes to power in January 20th. And in the first quarter of 2025, this ended. All this extend and pretend in the FHAs ended. And there were 92,000 foreclosures filed. So 9 in all year of 2024, 92,000 in the very first quarter of 2025. And there's 12 million of these. So we've talked about this before. When you only put 4 or 5% down, let me go to my last slide here. And let's just see if I can just illustrate this just a little quicker. When you're right here and you put 4 or 5% down FHA or 3-5% down conventional, you don't have much equity in property, and then it drops. It doesn't have to drop much, and all of a sudden you're underwater. So that's how that happens. There's not a lot of this. Everybody says, but there's huge equities. I'm sorry. In the affordable space, there just is not a lot of equities in these properties. And these are going to cause a problem. We're going to talk about that really, really quickly. So let me go open this up a little bit so you can see the slides. And let me go to the slides and you can take a look. Now, this is going to be the case. You're going to see once this hidden foreclosures coming in, and it gets to be a cascading problem. Here's the other thing. We've been talking about the fact that this is looking at you have value, and that based on comps, and then you have income value as based on income. So we here in Phoenix, Arizona, when we've been in a ZIRP, zero interest rate policy, when you can get 4.5%. So here's our cap rate was 4.5%. So property value equals the income, and we've been getting about $18,000 a unit. And you divide it by the cap rate, which was 4.5. It justified a $400,000 purchase price, and that's where a lot of these were at. Now, what happens when interest rates in the real world start coming back up? So after 2020, the bond market topped, and that was it. That's all she wrote. Interest rates are going up from there. Now, in my career, most rates were between 6 and 8. And during the great financial, right prior to the great financial crisis, we were looking at 6 to 8 cap. That was normal. Now, during the great financial crisis, I'm going to tell you, I made some great buys. I got 17 cap on some of these properties, 20 cap on the properties because nature hates a vacuum, and they always resolve these problems, always to the extreme. So you have an extreme, goes to an extreme, and eventually bounces back out. But normal is 6 to 8. 4.5 is not. But 4.5 look pretty good when you can't get anything else. When you got a zero interest rate policy, you can get a 10-year Treasury for like 1 or 1.5%, or leave your money in the bank at 0.25%, 0.25%. I mean, 0.25%. So 4.5 look pretty good. Now that you're looking at getting a money market for 4 or 5%, well, why would you take any risk for 4.5? So interest rates, cap rates will probably go up. Ken McElroy says the same thing, and I'm in complete agreement with him. But as the interest rate and the cap rate goes up, oh boy, the value of that property plummets. It just falls like a rock. Let me open this up so you can see that. This is just strictly math. This is really, really easy. So if you look at this, this just happened. So if you don't like cycles and you say, oh, the cycles are baloney, well, here's two examples that tell you that this is probably going to happen. And it's going to take a while to get, 1.2 million. That is just the tip of the iceberg. You just have to know that. The moment we start getting some unemployment and people could no longer make their house payments, these foreclosures are going to expand like crazy. I've been in business for a really, really long time. I've seen this before, and this is exactly what happens. So the cycle is telling us that we are going to have a very, very rough time. It's going to get incredibly better, just incredibly better. But we've got like a rough patch of the next 2 years probably, in which there's going to be turmoil. But we as investors, if you've got yourself put together, you've got your credit, your capital, and your income put together, we're going to make a fortune. Because there's going to be a clearance sale. All these properties are being foreclosed on. The banks are losing money. That has to be cleared out of the marketplace, has to be cleared out of the banks' net sheets. They don't like this stuff on there. So they're going to do whatever it takes to get rid of them. Excuse me. And that is where banks make a lot, these big funds bought tranches of homes. We probably won't be able to do that. But we're going to make a lot of buys. In 2009, I could buy 10 homes a day, every day. And I could buy a 3-year-old property in Phoenix, Arizona, 3 years old, for $50 a square foot. So I was buying 1,500 square foot homes for $75,000. I don't know if it's going to get that low, but I'm going to guess we're going to get some pretty good buys. And here in Phoenix, look at, we're becoming the chip manufacturing. We're no longer a construction town. We're a manufacturing town. We've got chip plants like crazy. The NVIDIA just did $100 billion contract with Taiwan Semiconductor to be made here in Phoenix, Arizona. And consequently, Taiwan Semiconductor is now expanding their plant. They're going to put another $100 billion in plant. So this is going. We're going to get tens of thousands of high-tech workers. We've got a lot of construction workers, building manufacturing. We've got Intel here just did another JV with Taiwan Semiconductor. So lots of really good things going here. Plus, we're so close to California. California is just throwing their entrepreneurs away. They don't like people who are interested in doing business. They just throw them away and they come here. So it has become that, when we get into our East Valley, we're starting to become the number 2 startup in the country because we're close to Silicon Valley, and people in Silicon Valley find out that we're just as smart in Arizona as they are in California, and you can do it for like 30% of what you can do it in California. And your workers can find a nice home. They can live in a nice community, crime-free, well cared for, and it's just good all around. So here's the deal. I'm telling you right now that our cycle work is saying that we have turmoil coming. I've been saying that for a long time because it's 4 years, and I've been trying to keep you from buying at the top. We saw the top come in, and we've been telling people not to buy, because if you buy, it's going to take you 10, 15 years. Maybe you'll never recover from it, because it could be very, very serious. People could lose everything they have on this. And I have been trying to keep you out of it. As a real estate agent, I love to make commissions. That's my job. But I've got a big portfolio of properties. I don't need your money. Want your money? Yeah, it's kind of fun to make a commission. I've got no problem with that. But I don't have to sell you down to the river to make my mortgage payment. And we saw the river was flooding, and people were going to get swept away if they purchased at the wrong time. Now I'm telling you, get ready, because we're going to purchase at the right time. It's going to be scary as all get out. When we call you and say let's buy, people are going to say, "Oh no, I'm not going to do it. It's way too scary. Everybody's losing their house." Yes, they are losing their house. That is exactly what's going to start happening. People are going to lose all kinds of stuff. It's going to be terrible. But this is when fortunes are made. And this is where generational wealth, if you feel like you were left out in the last couple of cycles, here's your opportunity. If you don't have enough money in your retirement account, here's your opportunity to do this. And for people who are looking to retire in 10 or 15 years, what an opportunity. This is just coming. I've kept you out of the market since 2022. I'm telling you, I'm coming back in the market. Not yet. I'm still looking for it to break. I'm looking for the stock market to break soon. And then I'm looking for the Federal Reserve. And after that, we're going to have our waterfall event. And once that happens, guys, we are going to load up the truck. We are going to buy absolutely everything we can. Still maintain our buy protocol. Still maintain our cap rates. We want to make sure that we buy these properties well. We're not going to buy anything. We're going to buy really, really good stuff that we're going to keep for 10, 15, 20 years and just take cash flow out of these things. It's a game changer. It's a life changer. If you're interested in getting involved with us, I've done this for a really, really long time. No one has ever lost any money with me. And we've got lots and lots of people who are getting a check each and every month. I've got a full team here. I've got 5 property managers that we do business with. They're all flat rate, which means that they're not a percentage. They're not your partner. They're just a vendor. So they typically are from $80 to about $120 a door. So if you're getting $2,000 a month or you're getting $5,000 a month, same price. And they'll take it. They'll take care of absolutely everything. I've vetted them. They're good. You're welcome to reach me. You can look at my prior videos. I'm at. You can call our corporate office in Phoenix, Arizona, 602-945-4200. I probably should have put I should have put on the end. Anyway, my very best to you guys. I love your comments. If you like this, give me a big thumbs up. Love your comments. Love to hear what's going on in your neck of the woods. Remember, not all markets are going to be the same. Some are going to be way better than others. And some are just going to, if you're in Austin, Texas, or Fort Myers, Florida, I think you better buckle up, because I think you're gonna see some, Tampa's already starting to crumble. So call me if you need me. I do consultations, and we try to make sure that we're doing absolutely the best thing for you. I'm a fiduciary, and I'm here to help. If I can help you in any way, I certainly will. My very best to you guys. Bye-bye now.